Hi, I'm Jimmy. In this video, we're going to look at Chevron, ticker symbol CVX. This video is part of our Dow 30 series, where we're analyzing all 30 companies in the Dow Jones Industrial Average to see which stocks could be the best buy today. I'll leave a link in the description below to all the companies we've completed so far. Okay, so we're going to look quickly at Chevron's business, and then we're going to see if we can come up with a fair value for Chevron stock using discounted free cash flow, but we're going to have a little twist to it. Okay, so let's jump right in. So this is the breakdown that Chevron gives us. This is their revenue by segment. And we can see that they have two primary segments, both downstream and upstream. This is according to their 2020 revenue. And in 2020, we can see that downstream dominated the revenue. Now, just so we're all on the same page, within the energy industry, there are three primary segments, three primary lines of business. They call them upstream, midstream, and downstream. Upstream is basically where they find and they drill for oil and gas. Basically anything they do to get it out of the ground. Midstream is where they ship it, they transport it, they store it. And then finally downstream is where they do things like they refine it and then they sell it at gas stations, things like that. A lot of times you might hear that called marketing if you ever read through their financial reports. And like we saw before, Chevron focuses on the upstream and the downstream business. Now we go back to their revenue breakdown here. Well, we can see that 2020 had their downstream revenue at about 72% of total revenue. Now, I think we can all admit that 2020 was a bit of an unusual year. So what I've been doing recently with a lot of the companies that I analyze is I go back to previous years. So this is their 2019 revenue. And once again, revenue is dominated by their downstream business. The same thing held true in 2018. So clearly, downstream is very important to the overall revenue generation for the business. And just as a reminder, their downstream is their refining and gas stations, things along those lines. But we should also recognize that while downstream dominates their revenue, upstream is a much more profitable part of the business. Just to illustrate, this is Chevron's net income in 2019. So basically their overall profit. And we can see from a percentage basis, things look quite different. Upstream generated nearly 4 times the profit, 4 times more than downstream. So from a percentage basis, they're a much more profitable business. When we switch over to their net income margins for 2018, well, once again, upstream dominates the downstream business. So net income margins are much, much larger in the upstream business. And if we're curious, if we want to check it 1 year further back in 2017, once again, the numbers were dominated by the upstream business. Now, we should also point out that the upstream business, the profits generated in that line of work are largely driven by the price of oil. So basically, if Chevron can extract a barrel of oil for a somewhat steady cost, the cost to pull it out of the ground is going to cost them a certain amount. The higher oil prices are, or gas prices for that matter, well, the larger their profit margins will be. This is one of the advantages and disadvantages for energy companies like Chevron. Profits and ultimately the stock price can be largely driven by what oil and gas prices are doing. Now, with that being said, let's look at some of the numbers and then we'll see if we can come up with a fair value for Chevron stock. So this is a chart of Chevron's revenue going back about 15 or 16 years. And as we can see, it hasn't been all that great. Now, I understand 2020 being on the low end. A lot happened that year. I think we can excuse that. But this chart is so volatile, I think it makes predicting future numbers very difficult. Now, one of the keys to this type of volatility, as we may have guessed, is that this movement is often tied to the underlying price of oil, which we can't forget is what Chevron is able to sell their products for. So, and I also should point out, I know downstream is a big part of the revenue generators, but gasoline prices are very much tied to what oil prices do. So they often move higher together and lower together. So higher oil prices generally means higher gas prices, which is good for their revenue on all their businesses. And just to illustrate how the price of oil can affect revenue, let's overlay the price of oil, the average oil price throughout that year for each given year here. And just as one example, back here in 2008, when they had very good revenue numbers, well, oil averaged about $100 a barrel. Now, that was not the high. The high during that year was up near $145 a barrel. So it's very possible that Chevron was able to generate a lot more revenue during that time period. But the average price was about $100 a barrel. And then up here, well, during this time period, well, oil prices stayed up fairly high. And then what happened? Oil prices began to tumble back in 2015, and so did their revenue. So I just want us to recognize the correlation between oil prices and overall revenue and ultimately profit. Because the reason this matters so much is it makes using traditional valuation methods, something like discounted free cash flow, which I frankly love to use, it makes it very tricky to use. Because frankly, going into the research for this company, I thought discounted cash flow was going to be a layup of a valuation method because it's such a long, well-established company. Typically, discounted cash flow works well for this type of thing. But if we're curious, this is the calculation I did for their discounted free cash. We got a fair value, debt-adjusted fair value of about $170 per share. Right now, Chevron is trading closer to $100 per share. So this calculation would imply that Chevron is trading at an enormous discount to our calculation of fair value. By the way, if you're curious how to do this, I did a whole video on how to do discounted cash flow. If you're curious, I'll leave a link to that video in the description below. There's an Excel template and everything. Anyways, I'll leave a link in the description below. But either way, this is why we really need to understand a company before we can go ahead and just accept the discounted free cash flow calculation that we would initially do. Because as we now all know by looking at their numbers and going through their business, well, what are the odds that discounted cash flow numbers actually turn out to be like that? Just to illustrate, this is a chart of Chevron's free cash flow numbers going back the past few years. And as we could see, well, these numbers are even more volatile than what we saw in their revenue numbers, since capital expenditures swing a lot for this type of company. And we already know cash flow from operations is going to swing because we know revenue is swinging, profit is swinging because of what the underlying business is actually doing. And just to further illustrate how insane discounted cash flow happens to be in this situation, well, look at what happens when we add discounted free cash flow, the estimates from analysts, to this chart. Now, sure, no one number is outrageous. To me, they're a bit on the high end, but if you told me any one year could be these numbers, I would totally believe it. That's very possible. But what are the odds that all 4 years happen anywhere near that? Because I trust analysts to figure out what a company is doing. I'm not sure I trust them to predict what oil is going to do. And the only way they can get these numbers anywhere near close to accurate is if they reasonably accurately predict what oil is doing. So again, that's why I think it's important not to just take basic discounted cash flow numbers, do a quick calculation and say, okay, this is what the fair value should be. I think it's a great great first step to decide whether or not we want to research a company further. But then we look at this and we look at how these numbers look relative to history. And I think we can sort of call this a bit ridiculous. And it makes it much easier now that we know what's underlying the business to dismiss this. So better than discounted cash flow for energy companies, for a company like Chevron or Exxon or Shell, those types of companies, could be something like enterprise value to EBITDAX. And just so we're all on the same page, EBITDAX is short for earnings before interest, taxes, depreciation, amortization, and exploration. And exploration is key in the oil and gas industry. A lot of companies, a lot of other industries that aren't necessarily tied to energy, well, exploration, or if they were looking for new businesses, things like that, well, that would be built in to the EBITDA numbers. But in energy companies, they break it out. So we have to basically, to make them comparable like we would enterprise value to EBITDA with other companies, we should use EBITDAX. You could get away with EBITDA sometimes, but EBITDAX makes more sense. So this is a chart of Chevron's enterprise value to EBITDAX going back the past few years. And again, I like this type of method. If you can't find EBITDAX, and just try using EBITDA, but I think that this is a slightly stronger number with this industry in general. And we can see that right now, their average over this time period is about 32x. Right now, they're trading at about 38x. This implies that they're slightly overvalued. Ideally, we want to pay on the lower end of their historical average. Now, if we ever see oil take a nosedive, I'm actually a big fan of Chevron's business, and if oil took a nosedive, it would be likely that Chevron would follow suit. And I think that at that point, they could be a great value. They could be a great opportunity to jump in and buy one of these big industry dominant companies like a Chevron or an Exxon. In this case, Chevron. We'll get to Exxon later in our Dow 30 series. But for Chevron, I like the business. It's a very efficient, well-run company. They just need oil to go their way. Now, the reason I say we should wait for oil prices to drop or to have a pullback before we consider jumping in and buying Chevron is that this is a chart of Chevron stock over the past 5 years. And if we add the price of oil to this, well, we can see that they don't move exactly the same, but they do have very similar trends. They seem to jump and to drop around similar time periods, and we know why. So if oil does drop a decent amount, perhaps we could pick up Chevron at a reasonable price. Now, since Chevron currently appears to be overvalued, another possibility is to look more towards real estate companies. Now, I actually did a video recently where I looked at 5 dividend-paying REITs, or real estate investment trusts, that could do fairly well in higher inflation, which we are currently heading towards in a fairly rapid manner. So if you're curious, perhaps that's a good next video for you to watch. I've got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thank you, and I'll see you in the next video.